Suppose you pay $20 for 1 month of an AI assistant. You ask it to write a polite email. The answer appears in seconds, and your bill remains $20. Now ask it to write another email. Your bill still does not change. But the AI system must perform another computation to produce the new answer. You pay no additional fee for that request, but serving it still has a cost. This creates 3 separate questions. How much does it cost to produce a usable answer? How is your $20 payment divided between the application and its suppliers? And what is the answer worth to you after you use it? The subscription price alone cannot answer all 3. We must track the cost of producing the result, the price the user pays, and the value created when the result leads to an action. Now follow the work required to produce one answer. The server converts the prompt into tokens and places the required data in memory. Accelerators process those tokens using the model's parameters and calculate which token should come next. The new token is added to the text. The system then performs another calculation for the next token. This process repeats until the answer is complete. During these calculations, hardware moves data between memory and accelerators. If the model runs across multiple accelerators or machines, network equipment also moves data between them. The hardware consumes electricity, produces heat, and requires cooling. A longer prompt requires more initial processing. A longer answer requires more rounds of token generation. Both usually increase the amount of computation. The exact serving cost depends on the model, the prompt and answer lengths, the hardware, and how efficiently multiple requests are processed together. But the central fact is simple. Every additional request occupies computing hardware and consumes energy. The user may pay no additional fee, but serving the request still has a real cost. Now follow the payments between companies. The customer pays the application, and the application records that payment as revenue. If the application buys model inference from another company, that payment is a cost for the application and revenue for the model provider. If the model provider rents computing capacity, its payment is a cost for the model provider and revenue for the cloud company. The cloud company then pays suppliers for accelerators, networking equipment, data center equipment, and electricity. Each payment is recorded as revenue by the company receiving it and as a cost by the company making it. This means revenue is recorded again when one company purchases an input from another. Adding the revenue of every supplier, therefore, does not equal the amount paid by final customers. One constructed estimate used early 2026 revenue rates for a selected group of AI suppliers. In that calculation, semiconductor companies accounted for about 70% of the revenue recorded across those companies. This was not an audited measurement of the entire AI industry. It also does not mean that 70% of every subscription payment went to semiconductor companies. It describes where revenue was concentrated within the selected supply chain. The results suggest that companies supplying scarce computing hardware were receiving a large share of recorded payments, even though customers interacted with applications at the other end of the transaction. But recorded revenue does not tell us how much profit each company kept or how much value the customer received. Those require different measurements. Consider one simplified transaction. A result creates $140 of benefit for the customer, and the customer pays the application $100. Begin with the application's accounts. It receives $100. That is its revenue. To deliver the result, the application pays $30 to an external model provider. It also pays $10 to employees directly involved in providing the service. Gross profit subtracts both direct costs. $100 minus $30 minus $10 leaves $60 of gross profit. Gross profit is not the company's final profit. The company may still need to pay for product development, sales, administration, and other expenses. Value added answers a different question. How much of the application's revenue was created inside the application company rather than purchased from another company? For this calculation, subtract only the $30 service bought from the model provider. $100 minus $30 leaves $70 of value added. The $10 paid to employees remains inside this calculation because their work was performed within the application company. In this simplified example, the $70 of value added consists of $10 in employee compensation and $60 of gross profit. Finally, calculate the customer's benefit. The result was worth $140 to the customer, but the customer paid $100. The difference, $40, is consumer surplus. The same transaction therefore produces 4 different measurements: $100 of revenue, $60 of gross profit, $70 of value added, and $40 of consumer surplus. None of these numbers can replace the others because each answers a different question. In November 2022, generating 1 million tokens at roughly a given level of benchmark performance cost about $20. By October 2024, comparable performance cost about 7 cents. The price had fallen by a factor of more than 280. This seems to imply that total spending should fall. But price is only half of the calculation. Total inference spending equals the price per million tokens multiplied by the number of millions of tokens used. Suppose 1 million tokens costs $10 and users consume 1 billion tokens. 1 billion tokens contains 1,000 groups of 1 million, so total spending is $10,000. Now suppose the price falls to $1 per million tokens, but usage rises to 50 billion tokens. That is 50,000 groups of 1 million, so total spending is $50,000. The price fell by a factor of 10. Usage increased by a factor of 50. As a result, total spending increased by a factor of 5. Lower prices make many more uses economically practical: longer prompts, more generated images, repeated tool calls, automated tasks, and more requests for each completed job. If usage grows faster than the price falls, total spending rises. Consider a writing task that normally takes 30 minutes. If the worker costs $60 per hour or $1 per minute, the task has a labor cost of $30. In a randomized study of professional writing tasks, people using AI completed the tested tasks 40% faster, while their work received quality scores that were 18% higher. We will use only the time result in this calculation. 40% of 30 minutes is 12 minutes. At $1 per minute, those 12 saved minutes are worth $12. Now account for the remaining costs. Suppose reviewing the AI's answer consumes 2 of those minutes. That costs $2, leaving $10 of value before paying for the AI service. Suppose the application charges $3 for the request. The customer's net benefit is therefore $7, $12 of saved time, minus $2 of review, minus the $3 price. The application records $3 of revenue. If generating the answer costs it 30 cents, $2.70 remains before fixed costs. Together, the customer's $7 benefit and the application's $2.70 add up to $9.70 of net value. But the entire calculation depends on one condition: the answer must be good enough to use. If the customer rejects it, the expected time saving disappears, while the review and computation still cost money. The previous calculation assumed that the AI's answer was good enough to use after a short review. Change that assumption, and the productivity benefit can disappear. In the writing experiment, people using AI completed the tested tasks in 40% less time, and their work received quality scores that were 18% higher. In another study involving 5,179 customer support agents, workers using AI resolved about 14% more issues per hour. But consider a different kind of task. In a randomized study, experienced developers used early 2025 AI tools to work on open source repositories they already knew well. With AI, they took 19% longer. Before starting, they had expected AI to make them faster. The difference is that generating an output is only one part of completing a task. The user may also need to explain the context, inspect the result, find mistakes, make corrections, and integrate the result into existing work. In the developer study, this additional work outweighed the time saved by generating code. So the productivity calculation is simple. AI helps only when the time it removes is greater than the time it adds. That balance depends on the task, the user's existing knowledge, the amount of context the AI needs, and the cost of checking and correcting its output. Model capability alone does not determine productivity. Suppose employees across a company send 1 million messages to an AI system. Does that mean the system increased the company's profit? The message count alone cannot answer that question. A McKinsey respondent survey illustrates the gap. 88% reported that their organizations used AI in at least one business function. About 1/3 said their organizations had begun scaling AI programs. 39% reported some organization-wide effect on operating profit, and most of that group reported an effect of less than 5%. These percentages answer different survey questions and use different denominators, so they should not be treated as stages in a single funnel. But they establish an important distinction. Using AI, scaling AI, and producing measurable financial results are different achievements. Giving employees access to a model is only the first step. A reliable deployment may also require access to company data, security permissions, software integration, output evaluation, employee training, workflow changes, and human review. Each requirement consumes money or employee time. So a company cannot measure AI's financial impact by counting messages. It must measure the value of results that were accepted and used, then subtract the full cost of producing, checking, correcting, and integrating those results. Only when the accepted value exceeds the full workflow cost has the AI system produced a positive financial return. During the recent AI expansion, demand for accelerators grew faster than manufacturers could supply them. Buyers competed for a limited number of chips. This allowed accelerator suppliers to charge high prices and earn high margins. Companies responded by building more data centers, designing custom chips, and using existing hardware more efficiently. In 2025, the combined capital expenditures and finance leases of 5 large hyperscalers approached $500 billion. This measures investment in long-lived assets and financed equipment, and it includes substantial spending unrelated to AI. But installing more accelerators does not guarantee more usable computing capacity. Every data center also requires electricity. Suppose its accelerators are installed, but its connection to the electrical grid is not ready. Until that connection is available, the new machines cannot serve requests. The IEA estimates that grid constraints could delay about 20% of planned data center projects. The same principle applies after computing capacity is available. A company may still lack usable data, security permissions, reliable evaluation, or experts who can review the output. Adding more computing power does not remove those constraints. At any moment, output is limited by the required input that is hardest to expand. The supplier controlling that input can usually charge more and retain a larger share of the payment. As investment expands one limiting input, another input may become the constraint. That is why the companies capturing the most value can change as the industry develops. Suppose someone using a free AI assistant asks which laptop best fits their needs. If the answer saves time or leads to a better purchase, the user receives value. But because the user paid nothing, the provider records no subscription revenue from that interaction. This distinction matters at scale. OpenAI reported more than 900 million weekly ChatGPT users in May 2026. A large study of consumer usage found that more than 70% of activity was unrelated to work. People used the product for guidance, information, writing, learning, and planning. Many of these interactions created value for users without producing subscription revenue. The provider still needs a way to earn money. It can charge users for subscriptions, charge advertisers for exposure, or receive a commission when a user completes a purchase. Paid recommendations can create a conflict. Suppose the assistant recommends a particular laptop and receives a payment if the user buys it. The recommendation may now serve two goals: finding the best laptop for the user and generating revenue for the provider. If users cannot tell whether a payment influenced the recommendation, they may trust it less. They may ask fewer questions, ignore its suggestions, or use another product. So revenue and user value are different measurements. A monetization system can generate revenue, but if it weakens trust, it can also reduce the usage and user value on which that revenue depends. Consider a customer support agent handling one case. The agent reads the customer's message, identifies the problem, finds the relevant information, drafts a response, decides whether an exception is justified, and remains responsible for the final answer. AI may classify the message, retrieve information, and draft the response. The agent may still need to check the facts, apply company policy, communicate with the customer, and approve the result. Some tasks become faster. Some remain human tasks, and checking the AI creates new work. This is why exposure does not mean elimination. The ILO estimates that 1 in 4 jobs worldwide has some exposure to generative AI. In this estimate, exposure means that AI could change at least some of the tasks within those jobs. It does not mean that 1 in 4 jobs will disappear. The effect on labor demand depends partly on how much output the company produces. If the number of customer cases remains fixed, completing each case faster may reduce the required labor hours. But if lower costs allow the company to serve more customers, total output may increase. Employment cannot be predicted from the time saved on one task alone. There is also a longer-term effect. New agents often develop judgment by handling simple cases, making mistakes, and receiving corrections. If AI performs those beginner tasks, the company may become more productive immediately, while new workers receive fewer opportunities to develop expertise. So evaluating AI's effect on a job requires 4 questions. Which tasks become faster? Which tasks remain with the worker? How does demand change when costs fall? And how will future workers acquire the judgment the job still requires? Return to the user who pays $20 for 1 month of an AI assistant and asks it to write an email. The entire $20 payment is recorded as revenue by the application. The application uses part of its revenue to pay for its employees and operations, and it may pay a model provider for generated answers. Payments can then continue to cloud companies, hardware suppliers, and electricity providers. We cannot determine each company's share from the $20 price alone. That requires information about the user's total activity, the application's supplier contracts, and the cost of serving each request. The value received by the user is not another share of those $20. It depends on what happens after the answer is generated. If the user rejects the email, it creates little or no value. If the user checks it, sends it, saves time, and achieves the intended result, the value may be greater than the subscription price. Falling computation prices can reduce the cost of each result. But if usage grows faster than the price falls, total computing spending can still increase. Competition determines how much of the cost reduction reaches users. A supplier controlling a required input that remains difficult to expand can retain more of the payment. So there is no single answer hidden inside the $20 price. We must measure 3 quantities separately: the full cost of producing an accepted result, the price the user pays, and the value created by the action that follows. Those 3 measurements tell us where the money goes and who ultimately benefits.